Long-term liabilities appear on the balance sheet as obligations due beyond 1 year. Debt instruments are structured with terms that dictate repayment, and the amortized cost method accounts for them by spreading interest over time. Debt extinguishment gains or losses occur when debt is settled for more or less than its carrying amount, impacting financial statements. Liabilities represent probable future sacrifices of economic benefits due to present obligations from past events. They require an entity to transfer assets, deliver goods, or provide services to another entity in the future. This encompasses existing obligations necessitating future cash payments, goods delivery, or service provision. Bonds are formal promises to repay borrowed amounts plus interest. Debentures rely on a company's credit, while secured bonds use collateral. Mortgage bonds are backed by real estate. Serial bonds involve periodic principal and interest payments. The bond indenture agreement outlines the borrowing terms between issuers and investors. Bond certificates typically have a principal amount of $1,000, known as par, maturity, or face value, repaid at maturity. The certificate shows the stated interest rate used to calculate annual interest payments, principal X stated rate. The issue price affects the bond's effective yield, indicating the true return rate. HUF bonds, with a 10% stated interest rate, face a challenge as inflation expectations rise. Investors now seek an 11% return, compelling HUF to issue bonds at a discount. This discount ensures the effective yield aligns with market demands, reflecting the increased risk and return expectations. Critics argue generally accepted accounting principles allow manipulation of accounting numbers, especially with debt at amortized historical cost. Debt for debt and debt for equity swaps can be used to influence financial statements, generating gains and favorable ratios. These transactions may be driven by financial statement effects rather than economic benefits, potentially affecting managerial incentives and evading contract restrictions.